am here at the IMF headquarters with Gita Gopinath, the first Deputy Managing Director for the IMF at a time of highly fraught geopolitical tensions, all this discussion about fragmentation. You wrote a paper that was fascinating about fragmentation, just how much of it is actually happening, the onshoring, nearshoring, reshoring, et cetera.
Yes. So, Lisa, if you look at the data and if you look at just a superficial number, which is the ratio of global trade to GDP. Now that number is holding up really well and you think everything looks fine. But if you look under the surface, you're absolutely seeing signs of fragmentation. And if you look at trade between a US-centric bloc versus a China-centric bloc, that trade has gone down by much more than trade within geopolitically aligned firms. That's also true for foreign direct investment. So we are seeing these shifts, but at the same time, we're also seeing the role of connector countries like Vietnam and Mexico that are coming in and channeling supply chains around the world. And all of this can raise the cost, ultimately, of goods for countries.
Which is really the key question here, which is how much structurally higher is inflation in this new era of fragmentation?
This is a main concern, and these are numbers that we have to determine. And now, we're still at an early stage, so we aren't looking at very dramatic movements over here. But if this process continues, it could lead to much more inflationary pressures.
Do you have a rate in mind about, is it 3% or 4%? Is that the kind of rate we can imagine in this world?
Right now, based on the scale at which it's happening, I wouldn't say it will be that large. But again, the risk is if it heads in a much more worse direction.
It seems like this is the path of travel. Everyone's talking about fragmentation. Everyone's talking about protectionist policies. In an era where so many countries seem to be rejecting free trade, what's the IMF's role?
We have a really important role to play as a multilateral institution. You know, the world is moving away from a rules-based trading system. So what needs to happen is diplomacy and pragmatic approaches. And that's what we're trying to push for through this meeting, getting countries together to work at least on areas where they can agree on, like on services trade. There's much more progress that's happening on services trade. We need to work together on debt issues, on climate issues. That will hopefully rebuild trust and slow the process of fragmentation.
We also see an increase in geopolitical tensions, and we saw this overnight with the attacks in Iran. There were some real questions around what the price of oil would do. It did nothing, but that's as people were talking about de-escalation. Ed Yardeni yesterday was talking about the possibility of an oil shock akin to the 1970s, with oil prices going to $100 a barrel, should this escalate. Do you foresee a similar type of thing happening?
This is a risk we worry about. If there is a serious escalation, which means a much more wider regional escalation than what we've seen so far, then yes, we could have a severe oil shock. But we're not there yet, and as you can see in terms of oil prices, it went up some, but it's come back down. We have supply excess capacity in Saudi Arabia. We have non-OPEC countries putting a lot more oil out on the market. So there are other sources of supply that can, buffer these shocks. But if there's a large-scale escalation in the Middle East, that is a problem.
Is that the line in the sand, $100 a barrel, and that would consist of the shock?
I think going up $100 a barrel would be problematic, but even going from here to $100 a barrel would be difficult for countries to deal with, who are still fighting the last inflation fight, which is to bring inflation back down to target.
One thing that the IMF has talked extensively about is concern about sovereign debt, in particular in the United States and the overhang there. What's the outcome of that? Is the fear of some sort of slugflation or just sort of a sluggish growth kind of picture because of the overhang? Is it higher rates and potentially a Liz Truss moment, which I've been talking about and get shot at all the time in the U.S., but is there something like that that could potentially happen?
The U.S. is running very large deficits for a country where demand is very strong, and there is still the last mile in terms of bringing inflation down. So for all those reasons, the deficit, you can't have a deficit of 7% of GDP. It needs to be lower. And if you project out, it's going to stay at those high levels for a while. That has consequences, of course, for debt servicing in the U.S. But in a sense, the bigger problem is in terms of spillovers to the rest of the world. Because for the rest of the world, when you have so much of debt being issued by the U.S., that can crowd out the borrowing from other countries. their cost of borrowing goes up and their debt servicing costs go up by much more. So, I wouldn't say the U.S. has a debt sustainability problem now. But at the same time, when the U.S. is borrowing that heavily, that causes rates to be that much higher. It has implications for the rest of the world and for corporations and households in the U.S.
How much higher? I mean, could you see rates staying here between 525 and 550 for the rest of this year, for even into next year?
That would not be our baseline. We would expect to see rates coming down. So right now it's for getting inflation back to target. So we expect that will come down. It's going to take a little longer, but we expect that to come down. The question is whether it comes back down to what we saw in the decade after the GFC. And there, right now, that doesn't seem to be the case.
One thing that you talk about is this era of fragmentation is going to lead to a higher inflationary regime. Do you think it's appropriate for central banks to have a higher inflation target long term as sort of their goal, say not 2%, but 2.5% or somewhere between 2 and 3%, just because it is a different reality now?
Yeah. So firstly, that is a conversation we should not be having now. We need to ensure that inflation comes back down to 2%. Monetary policy can pin down a level of inflation. Yes, if you're going to have a lot of volatility in that inflation statistic, that could create problems because we are in a much more shock-prone world. But again, that is a conversation for later.
For later, but it might be.
Yes.